Here is how one very simple, easy to make misstep cost one investor nearly $150,000 in taxes. Essentially, it was a real estate investor that took a rental property and put it inside of an S corporation. Now, the simple act of just putting the property inside of an S corporation didn't trigger a taxable event for this particular taxpayer, even though it can trigger taxable events for other situations, most notably if you don't own over 80% of the corporation stock. Moving an appreciated asset into the corporation can trigger a taxable event, but that's not what happened in this situation. What happened is that this real estate investor actually wanted to transfer the property from one LLC over to another LLC. And S corporations do not have the same tax benefits as sole proprietorships or partnerships in regards to real estate. So what ended up happening is this transfer of the property from one LLC over to another LLC actually resulted in a taxable sale of the property. So even though there was no economic gain for the taxpayer, the IRS still considered this a taxable sale, and the taxpayer had to end up paying $150,000 in capital gains taxes. And that is a very costly mistake that could have easily been avoided had he been working with a tax advisor that was very familiar with real estate tax laws. This is why if you invest in real estate, you really need to work with someone that understands tax laws. And if you know anything about me and have been following my page for any amount of time, you already know that rentals inside of an S Corp is a huge no-no for me. I would never advise something like that to be done. And so if you are a real estate investor and you're looking for a tax advisor that is familiar with real estate tax law, shoot me a DM because I'd love to have a conversation with you to see if we'd be a great fit to work together.